Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings. Today we're looking at Wrap Technology's latest report and whether or not their financial restraints are well wrapped up. Get ready for a ride because this one is full of twists, and this report is basically a health check on Wrap Technologies, a company known for its bowler wrap, a remote restraint device used by law enforcement. We're diving deep to see if the company is thriving or just surviving. We'll break down the numbers, look at their challenges, and see what the future might hold. But before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us to discuss and make money. First off, let's establish what Wrap Technologies actually does. They develop and sell public safety products, mainly for law enforcement. Their big seller is the bowler wrap, but they also offer virtual reality training systems and body-worn camera solutions. Now let's talk numbers. Their net income looks positive, showing $109,000. At first glance that might look great, but wait, there's a catch. A big factor in that net income, a whopping $4 million from changes in the fair value of their warranty liabilities. Basically, this is a non-cash item, an accounting change. It doesn't mean they suddenly made $4 million in cash. If we look at the losses attributable to common stockholders, those look a little worse at around $55,000. Here's where it gets more interesting. Total revenue is $765,000. In the same period last year, it was $127.6 million. That's almost half the money coming in, a big drop. Gross profit also took a hit, down to $595,000 from $836,000. That's a 29% decrease, meaning they are selling way less product. Now let's look at where the money is going. Selling, general and administrative expenses are pretty high at $439 million. This means it costs them a lot to run the business even if they are selling less. Research and development expenses are $378,000, so they are investing less in research and development. That is good in the short term, but could hurt future growth. It might be a way to cut costs. But is that the best approach you decide? This is a key indicator. Net cash used in operating activities was around $3 million, meaning that their day-to-day operations are draining their cash. The company has $607 million in cash and cash equivalents. That's up from $6 million at the end of last year. The company is actively managing their cash. Total stockholders' equity is pretty shaky, though it has improved. Let's check the numbers. For March, that's $2.5 million, and at the end of the last year, it was a measly $250,000. Their liabilities are high because of warrants. These are basically options that allow investors to buy stock at a set price. The warrants are a liability because the company might have to issue more stock in the future, diluting current stockholders. Then they have something called Series A preferred stock. It involves more accounting stuff, but basically helps boost their assets. The report also outlines many standard practices and accounting overviews, a summary of potential future accounting outlooks, such as on page 7, but this is something every company needs to state and isn't too useful for us to analyze. There is also a large section talking about risk factors on page 30. It includes the usual, what can go wrong, and is also standard. These include any number of world events and legal challenges. Now let's cover some future liabilities. They have operating lease obligations worth $413,000 this year and increasing in coming years. A lot of those expenses come from the facilities they have to operate. These expenses also include additional expenses such as insurance. In early 2025, they acquired W1 LLC, which specializes in advisory and investigation services. They mention this added managed services as an added revenue component. The company highlights that the recent quarter of net income of $109,000 and the decrease of usage for operating expenses highlights that the company is managing themselves well despite an acknowledged challenging business climate. The private placement they did helped in particular increasing cash from operating activities. Overall, they used a less negative in 2025 for their operating activities as compared to last year. There are two clients responsible for 30% of revenue from the company in receivables. This means the company could face a revenue shortage if payment doesn't come through for these two. The SEC report didn't highlight anything afterwards, but let's see what we've decoded overall. Daxo. What's the verdict on Wrap Technologies? Are they getting tangled up or are they wrapping things up nicely? On the one hand, they managed to get some cash through a private placement and lower costs, but they are making less money. Are they growing or cutting back? Their warrants might hurt future earnings due to how much stock they might have to dilute. Overall, Wrap Technologies is in a tough spot. While the recent cost cutting and a rise in their stockholders' worth is good, they are selling less product. They need to demonstrate their products are useful and can't rely on accounting tricks like valuing the fair use of liability. What do you think? Will this company and their remote restraint device succeed? Drop your thoughts in the comments below. If you found this analysis helpful, please like this video and subscribe for more content. Also, make sure to channel in the description for even more hot takes. See you in the next one.